As the S&P 500 is recovering, many growth stocks are going up like never before. Palantir is up 57.5% year to date. Hims and Hers Health, which I talk about all the time, it's up 119% year to date. Robinhood, which I also talked about, it's up 45% year to date and around 30% from my last video just 11 days ago. And many of those growth stocks are up a lot year to date. Many of you guys are feeling the FOMO, the fear of missing out if you don't own any of them. But there's only one growth stock left. One growth stock was up to 900% on the upside. That's still negative year to date. It's a very hated stock, as hated as Robinhood. When I did the Robinhood video, I told you guys, whenever you're gonna find out the name, many of you guys will skip the video. And it's the same thing with this one. Whenever you find out the name of the company, many of you guys will skip, but I would highly encourage you to just watch the whole thing so you have no regrets, and then you could let me know your opinion in the comments whenever you finish the video. So I really hope you enjoy it as always. And this stock is again a stock that if you go on X, you see many people bragging that they sold it and they bought Robinhood. Robinhood's up 41%. The stock is down 11%, and they're bragging that they sold it and the other stock outperformed and this stock is trash. And whenever you see those things, this is normally a sign of, you could say, some kind of a major bottom in sentiment. It's a sign of capitulation, especially if the company has good fundamentals. And to me, this stock is a loading cannon that's being underestimated. And I believe this stock will surprise many people over the next 2 years. And you heard it here first. And this stock is SoFi. SoFi is still down year to date. It's still negative, one of the few ones. And if you look at SoFi, they always like to compare SoFi to Robinhood. And they believe that if Robinhood is taking market share in certain areas, SoFi just can't exist. Like SoFi and Robinhood, they cannot coexist. And this couldn't be further from the truth. In fact, SoFi grew members from 1.8 million members to almost 11 million members. They grew 800,000 members quarter on quarter. That doesn't look to me like some kind of a dying company. Robinhood could take market share and SoFi could also take market share. For instance, SoFi does have 11 million members, but if you look at the total US adult population, it's 262 million. 262 million people that likely need a bank account, they likely need a student loan, they likely need a home loan, they likely need a credit card, they likely need a personal account or some kind of an investment account or all kind of things that SoFi has and Robinhood have. So Robinhood and SoFi, they can both coexist. If Robinhood is innovating faster, if the stock is going up more than SoFi, it doesn't mean SoFi is a bad company. And the sentiment has been waiting on the stock. And again, I just believe it's a loading cannon and it's going to surprise many people. And we're going to find out if I end up being right or wrong. But for SoFi, it's not just a bank. They do have a banking kind of division, but it's the only app in the United States that has banking, credit cards, investments, loans, and many different things all within one app. SoFi doesn't just have regular loans. They have personal loans, they have home loans, they have student loans, all within your investment account, your credit card account, banking, all within one app. You don't need 20 apps. Everything is within one app, which is pretty amazing. And that's why the company has been growing so fast, is because they have 11 million members and they keep cross-selling them new products. So once you're in the SoFi ecosystem, let's say for a high-yield savings account, let's say, for example, you need some kind of a home loan to purchase a house. Instead of going to Bank of America, you're already into the SoFi ecosystem. So SoFi will cross-sell you the home loan product. They already have your data. They already have everything. And this is going to be a very high margin revenue, recurring revenue business model, because they don't have to advertise to you more than once. Once they bring you into the ecosystem, then they can cross-sell you hundreds of products. And this is going to be very, very profitable for the company. And it is actually becoming profitable in real time. The company grew 33% in revenues in Q1, which was actually a reacceleration from 2024. Adjusted EBITDA, 27% margin, it has been steadily increasing. Adjusted net income, it has also been increasing. And net income margin right now is around 9%. It went from negative 21% in 2022. Right now, it's around 9%. And this is a massive, massive improvement for SoFi. But if you're really buying SoFi, you have to understand one simple concept about the thesis. The main thesis with SoFi, which differentiated from Robinhood, is the fee-based revenue. So SoFi is more of a bank, you could say. So let's say a few years ago, what SoFi used to do is, let's say you come in and you want to get in a personal loan from SoFi. SoFi will give you the personal loan, but SoFi will hold the loan on their books. They will take the risk of you potentially not paying the loan back. And it's very, you could say, asset heavy, capital intensive business model. Now they are transferring and switching more into fee recurring revenue kind of business model. With this business model, SoFi doesn't hold the loan on the balance sheet. Other kind of capital management companies and other kind of wealth managers, they hold the loan, they take the balance sheet risks, they take the default risk. SoFi collects fees, origination fees for originating the loans, and then they collect some kind of a recurring servicing fees whenever you are paying your loan through SoFi. So that provides SoFi with high margin, fee-based, asset-light, recurring revenue business model. And it's beautiful, amazing, and this is why net income margins right now went from negative 21% to around 9%. And now the fee-based revenue is only 41% of total revenue, and it's eventually going to be pretty close to 100% of their revenues. So this is what you're mainly betting on if you're buying SoFi at this stage. And this is a very recent example where the company signed a $3.2 billion expansion to the loan platform business. And this is what the CEO said: the additional $3.2 billion commitments help us better meet borrower demand for personal loans while moving SoFi towards less capital intensive and more fee-based sources of revenues. And once they become dominantly a fee-based revenue business model, they will ultimately get a multiple expansion and the market will start to recognize the value. So if you understand what I'm trying to say here, SoFi has 11 million members. They have hundreds of products, a lot of products, okay? And they're growing 800,000 members every single quarter. They have most of their money coming in through asset and capital heavy business models. They're not only cross-selling a lot of products to those 11 million members, but they're not just taking market share, but they're also transferring at the same time from a capital heavy to a capital light fee recurring revenue business model. So the growth here is going to be amazing over the long term. And this is why I'm expecting 900% on the stock. Now, if you look at the company or the stock, it's trading around 40 times forward earnings. 40 times forward earnings might look very expensive on SoFi. It just looks expensive. But if you look at the company's guidance, they remain confident in delivering the 2026 earnings per share guidance in the range of 55 cents to 80 cents. And we are well positioned to deliver 20 to 25% annual earnings per share growth beyond 2026. And this is a company that has a track record of under-promising and over-delivering. So they always guide low for them to beat and keep raising guidance. They just raised guidance this quarter. They're going to raise guidance 3 more times. They did it the last 2 years, and they're going to do it again. So between 55 and 80 cents, if we take in 70 cents as an example for 2026 potential earnings per share, that would mean SoFi right now is only trading at 20 times earnings. 20 times 2026 earnings, and after 26 is going to grow in earnings per share 20 to 25% a year, which means you're buying a high growth company like SoFi, growing earnings per share 20 to 25% below 1 PEG ratio, below 1 time price to earnings growth. And that doesn't really exist in this market. So to me here, SoFi looks like a bargain, but I'm going to show you the numbers on why I'm expecting 900% over the next 10 years on the stock. And one more catalyst that many people are missing is the housing market potentially unfreezing. Scott Bessent said the housing market is stuck, but it will unfreeze soon. And this administration is focused on the 10-year. They are focused on the housing market. Now it's not working too well, and the 10-year keeps on going higher and higher and higher. But now with the tariff deals coming in, if the Fed potentially lowers interest rates and they start doing quantitative easing, we could as well have the housing market unfreeze into 2026. And SoFi is the best position to benefit from it, as they have around $2 billion in terms of lending volume. That's just origination for home loans. But it has been drying up over the last few years. It's between 1.8 billion to 2 billion. And it used to be $3 billion in the bubble of 2021. So if we have something like that happen again next year, it could jump to 4, 5, 6, $7 billion. So many people ask me, what is the best way to bet on housing? You're actually betting on housing if you own SoFi, because SoFi has an amazing origination division for home loans, which could be a massive tailwind into 2026 if the housing market does unfreeze. If people want to buy a house or they want to refinance, they can do it through SoFi, and SoFi already has 11 million members. So this is another tailwind that's not really priced in those estimates, and it's not really priced in the company. And by the way, I've been using FinChat for all those charts I'm showing you, because I couldn't find any platform that would show me, for example, the origination volume, that would show me the total member growth of SoFi. I just couldn't find anyone. So if you want to try it out for free, they give you 2 weeks of free access if you just use my link in the description, so you could check it out. But for my valuation model on SoFi, this is what I did. I took the 2026 mid-range guidance of 70 cents in earnings per share, and then I put it in for the 9 years after that. So this is a total of around 10 years from now. And I used 20% earnings per share growth. The company is guiding 20 to 25%. I used 20%. Many of you guys may believe I'm optimistic, but if you truly understand the ability of SoFi to be profitable, like if the fee-based revenue goes from 41% to, let's say, 60 or 70%, the company could even get a multiple expansion. But the growth here is massive alone. This is excluding SoFi's expansion into other areas of lending or other areas in cryptocurrencies and other kind of things, and even growing members over time and cross-selling them and being more profitable. It's going to be a profit machine. So I could easily see 20% a year for 9 years after 2026. In total, I get $3.61 in earnings per share 9 years from now, which is total is 10 years from now, for a 10-year estimate. And if we use $3.61, we have 3 case scenarios: worst case scenario, base case scenario, and best case scenario. Worst case scenario, in my opinion, is 25 PE. And many of you might tell me 25p is too high. But you have to imagine 10 years from now, SoFi will have most of the revenues through fee capitalized revenue business model. And this kind of business model deserves a higher multiple, okay? And the company will still likely be growing after 10 years from now. The banking and stuff is not going anywhere. But if we use 25 PE, we get $90.25 in share price 10 years from now, or 544% on the upside. Not bad at all for the worst case scenario. Base case scenario, which is where I'm leaning towards to, is 30 PE. I believe 30 PE will likely be fair. And this is again excluding if they grow 25% instead of 20 or if something else happens. But 30 PE, we get $108 per share or 671% on the upside. Best case scenario is 40 PE, so the multiple remains the same. And this is also a possibility if the company becomes an asset or capital light fee recurring revenue business model. It's very, very possible for the multiple to maintain itself at 40p. If that does happen, the upside is $144 or 928% on SoFi over the next 10 years. $144. Worst case scenario is $90, and the stock right now is trading at $14 per share. And I'm not worried about a recession because their personal loan borrowers have a weighted average income of $158,000 and weighted average FICO score of 744, and now they're not holding most of those loans. Other companies are holding the loans, and SoFi is taking little to no balance sheet risks on those loans. So this is my thesis on SoFi. It's a beautiful thesis. I hope you made it through this video. I hope you understood the thesis. This is likely gonna be my final video on this one, but I'm talking about it because I still believe it's the last opportunity available in this market in terms of growth stocks that have yet to be expensive and that have yet to have the hype and euphoria around them. And if you're interested in knowing what I'm buying, what I'm selling, or the next Hims and Hers, what I would say, I share everything I do in my own group. This is the link. But thank you very much for watching. Hope you enjoyed it. Not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.